This lesson belongs in every investor's toolkit, a step-by-step approach to evaluating any company like Warren Buffett uses, based on his famous checklist. But here we take it a step further, with 9 actionable steps from understanding the business to calculating intrinsic value and never forgetting the margin of safety. This isn't some get-rich-quick scheme. It's the bedrock of making sound investments. Let's dive in. Step number 1. Business understanding and economic moat. Before even thinking about buying a stock, you have to know the business inside out. What do they sell? Who buys it? And why? For example, if you want to invest in Disney, it helps to know that they make and sell entertainment content. They operate theme parks, own sports teams, and make money from streaming. Their customers are families and individuals looking for fun. Understanding the business basics gives you a clear picture of where the company's money comes from. But that's just the start. You also need to figure out how protected that money is, which brings us to the economic moat. This is what keeps a company profitable over the long run, like a castle's protective moat. But in business, it's not always obvious. It might be a strong brand that people love and trust, like Nike or Apple. It could be a massive network that connects buyers and sellers like Amazon or Facebook. Low costs can be a big deal too, like Walmart or Ryanair, who keep prices low and profits high. Or it may be tough rules and regulations that block competitors, like a pharmaceutical company with a patent on a life-saving drug. The trick is figuring out if this protection will stand the test of time. Will it still work in 10 years? Is it already starting to weaken? Take Blockbuster, for instance. They had a great business renting DVDs, but their moat was weak. Online streaming services like Netflix were already eating away at their profits. When Netflix started producing their own shows and movies, Blockbuster couldn't compete. In the end, they filed for bankruptcy and closed their doors. So when you're thinking about investing in a company, dig deeper to find out what protects them from being the next Blockbuster. Step 2. Industry cycle deep dive. No matter how great a business is, its performance goes up and down with the times. Some industries grow fast, then slow down. Others shrink while new ones pop up. That's why it's so important to study how the industry has handled cycles in the past, not just the good times. Imagine you're thinking about buying stock in a bicycle company because everyone seems to be riding bikes again. But before you jump in, ask yourself, what happens if car-free cities become less trendy, or when electric scooters hit the market? To answer this, research how long past trends lasted, how far they dropped and why. Also look at supply and demand. Are there too many bike makers? Does China control most of the parts? How will rising or falling interest rates affect people's desire to buy bikes? Basically, you want to map out the good and bad times and see how they impact the business. Consider both optimistic and pessimistic scenarios. For example, what if people keep biking? Or what if electric scooters become super popular? By doing this, you'll be ready for whatever comes next and can spot any hidden problems on the horizon. Remember, the more you know about an industry's ups and downs, the better you can predict its future. Step 3. Management quality and capital allocation. Even the best businesses can fail if they have lousy leaders. It's all about how management, the people at the top, use the company's resources. Do they reinvest the profits back into the business, pay fair dividends to shareholders, or waste money on stuff that doesn't work, like buying other companies that don't fit or making products no one wants? Look for signs of wise decision-making. Check how much of the company insiders own, because if they hold a lot, they'll be motivated to make it successful. Also, research how executives get paid. Is their pay tied to how well the company performs, or is it just a big fixed amount? If it's the latter, that's a red flag. Pay attention to whether there's a plan for when key people retire or move on. A good company needs a lineup of talented people ready to lead when the time comes. Think of it like a relay race. You wouldn't want to be in the middle of a race without knowing who's going to take over when you get tired, right? Step 4. Financial strength. Here's where the numbers come in. Look at the company's financial reports, especially at how revenues, Operating income and free cash flow have changed over 10 years. This will show you if the company's performance is steady or all over the place. Also, check their liquidity, meaning do they have enough cash to cover their debts and other short-term obligations. You can figure this out using ratios like interest coverage and debt maturity. Interest coverage tells you how easily a company can cover its annual interest payments with its earnings. If the number is high, say more than 3 times, it's usually fine. Debt maturity shows when the company needs to pay off its debts. If most of them are due in the distant future, it's less risky. These ratios are like speed bumps on the road. They tell you if the company is running smoothly or if there's a rough patch coming. Strong companies sail through tough times because they've prepared well, just like having a sturdy boat for choppy waters. Step 5. Intrinsic value estimation. Now it's time to figure out the intrinsic value. This is basically the true worth of a company, its assets minus its liabilities. But here's the tricky part. No one knows the future for sure, so you have to make some educated guesses and assumptions. The key is to make a conservative DCF model, which means include worst, normal, and best case scenarios. This way you'll have a range of possible values instead of just one guess. Don't forget to consider taxes and use a discount rate that matches the risk level of the company. Think of it like this. Would you pay the same price for a stock if it was a small local business or a giant global corporation? Of course not. Also, double-check your results with simpler methods like the PE or PFCF multiples compared to the company's history and similar companies. These tools give you a quick snapshot of how the market views the company's value. But remember, nothing's perfect. Any method has its pros and cons, so use them wisely. Step 6. Risk assessment. Every investment has risks. Even the brightest stars can fade if you don't keep an eye on potential issues. Operational risks could be anything from supply chain troubles to product recalls. Regulatory risks could come from changing laws or increased oversight. Macro risks are big picture stuff like economic slumps or shifts in consumer behavior. Your list should cover all these areas, but don't just write them down. Try to quantify the risk, asking questions like, how bad could things get? What would it mean for the company's earnings? If you can't wrap your head around a risk, or if it's constantly changing, mark it as too hard. That's what Warren Buffett does when he can't make sense of it. Remember, knowing the risks and how bad they could get helps you make a smarter investment decision. Step 7. Catalysts and long-term outlook. We can't predict the future, but we can spot events that might give the stock price a big boost. These are called catalysts. They could be new products, entering a fresh market, or even changes in laws that help the company. For example, if a company is about to launch a game-changing new phone, that could send its stock price soaring. Similarly, if a major city eases zoning rules to allow more apartment complexes, that could benefit construction companies. These are catalysts, moments that can shift the market and influence a company's future. But that's not all. You also need to think about long-term trends. How might things change in 5 or 10 years? What challenges could the company face? And what opportunities could arise? For instance, more people switching to electric cars will be a huge change for both car makers and oil companies. And don't forget about the role of ESG. Environmental, social, and governance factors increasingly affect business. Think about the carbon risks a coal company faces, or the reputation damage a fashion brand might suffer due to poor labor practices. Staying aware of these issues will keep you ahead of the curve. Step 8. Margin of safety and investment decision. After calculating the intrinsic value range, it's time to make a decision. Compare your range to the current stock price. If the stock is trading below your calculated value, you've got a potential bargain. But remember, no one's right all the time. Be prepared to buy, watch list, or pass based on your analysis. And always remember to leave room for error. This is your margin of safety. Want more insights? We've covered this in detail in our videos on margin of safety and intrinsic value. Step 9. Actionable summary. Before wrapping up, summarize your main points. List the top 3 reasons to invest and the top 3 reasons not to. Also use our famous checklist inspired by Warren Buffett. Check off the boxes for moat, management, financials, value, and risk. If the company ticks most boxes, it's likely a good fit for your portfolio. Our 9-step approach combines the best of Buffett's wisdom and modern insights. It's like having a roadmap for smart investing. If you enjoyed this lesson, don't forget to like and subscribe. And if you want more, we've got you covered with additional lessons on our channel. Stay tuned and keep learning. Thanks for watching.